performance of the obligation. So you don't necessarily need to have received the funds to recognize the revenue, but the minute that you have delivered the performance obligation and you've got the right to receive the cash, you have a contract in place, then you can actually recognize the revenue. Okay, and then the other line item that we're going to look at in the income statement are the expenses. So expenses are a decrease in assets, also in increases in liabilities that result in decrease in equity, other than those relating to distribution of holders of claims. So these costs are subtracted from the total revenue to get to the company's profit or loss. So what we have in the expenses line item is that we've got operating expenses. So these are the day-to-day expenses. It could be your salaries, your water, your rental, and then your depreciation would be the assets that are capitalized. So, okay, in terms of operating expenses, there's also this issue that we sometimes meet with the clients where you doing their books and they want you to recognize an asset all at once, while the useful life of it is longer. So that means that you need to capitalize it. So we're going to talk more about capitalization when we go to the statement of financial position. So when it comes to the recognition of operating expenses, it only has to do with expenditure that is incurred in that year, and that does not have to do with any capital acquisition. So capital acquisition is what I spoke about, acquiring assets that are going to be used for more than a year. So you can't recognize it. You can't recognize that as an operating expenditure. However, you can put it in the assets, in the financial position as an asset, and you depreciate it over the years in which you're going to use the asset. So that's the depreciation. And then non-operating expenses, and then you would have tax expenses and also income expenses. Okay, and then, okay, can I just go back to tax expenses? So some tax expenses would sometimes be different from those that you recognize as operating expenses. So what that would mean would be that sometimes your profit is not necessarily the taxable income. You might make 20,000 in a year, but you're going to pay tax on 40,000. Why? Because you had other expenditure, or you had other expenditure that may not be recognized on tax. I'm not going to touch more on tax, but that could be the case, and you end up paying more tax. So sometimes we have those disputes with the client where they say, but I made 20,000 in profit. Why am I paying tax on 40,000? So you just understanding tax. I think you can attend one of our webinars where we talk about tax, or you can go watch our previous webinars, and then you understand more about why there could be a difference between your net profit, your net profit, and also the taxable income that we declare to SARS. Okay, net loss or net profit, bottom line. So the profit line, it refers to the company's net profit or loss. It's the final figure after accounting for all the revenue and the expenditure. So it's also important for the profitability to be understood. So if you understand, or if you have an understanding of why you're profitable, you'll be able to assess your financial health, your performance evaluation, and also you can make dividends payments based on that. And you also need to understand the tax implications that come with the profit as well. So I had also kind of spoken about the tax implications. So when you make a profit, just if you're an accountant already, I think you'd understand that. But if you're not, just give your accountant might need to explain why you might pay tax or why you might not pay tax in that year, depending on your profitability, which is also taxed on a sliding scale, depending on the type of business that you've got. If it's a micro business, it's on a sliding scale. If it's just a normal business, it's the normal rate that you would use, which is just 27%. And then with balance sheet, which is what I refer to as the financial position, statement of financial position. So this gives you a snapshot of a company's financial position at a specific point in time. So with the financial position, it basically gives you how much you've accumulated over the time in your business. It differs from the statement of profit or loss because the statement of profit or loss just records what you've done in that period. So if you're starting the year in March and it ends in February, the statement of income and income and expenditure only records the expenses from March to February, while the balance sheet accumulates everything. So if we started the business in 2009 and we've bought assets over the years, all that you put it and pile it in the balance sheet. Whatever is depreciated, written off, is removed as in time goes by, but that's what records the accumulation of the assets, liabilities, and also the equity of the business. Okay, and then in terms of the assets, so we've got a classification of assets. They can either be recorded under current assets or non-current assets. I'm going to start with non-current assets. So what non-current assets record? They record the assets that are not expected to be converted into cash within a year. So these are your assets that are not necessarily that are not going to be easily convertible into cash, or you're not anticipating to sell them within the upcoming year. So when you're saying within the upcoming year, we're saying that if your year end is 2024 February, you're not expecting to sell the asset between March 2024 to February 2025. So when you're not expecting to sell that asset within that time, it could be your vehicle or your house, then you put it in, or not necessarily house, but your properties, you put them under non-current assets. And then you would also have your patents, your trademarks, your investments, and your goodwills, if you're not expecting to convert them into cash within a year. And then within, so the property, plant, and equipment. So this is where we record the assets that I was referring to that we capitalize. So this is the assets that you're not going to use within a year, and they've got a longer useful period. You record them under property, plant, and equipment, and also you depreciate them every year, depending on the depreciation rate. For vehicles, for example, the industry norm is that you usually use a vehicle within 5 years, but if you assess that you're not going to use it within 5 years, if you're going to use it within 3 years, then you change your depreciation rate into depreciating it for 3 years. If you think you're going to use it longer with whatever reasons you've got, then you extend it, but it needs to be reasonable. The reason why you're actually not going with the industry trends. And then with the current assets, so this is where you record assets that can easily be converted into cash within a year. So this includes your cash and cash equivalents, which is your cash in the account, in your bank account. It's also your petty cash in your drawer in the offices. It's also accounts receivables, which is what your debtors are owing you. It could also be your inventory if you hold inventory. It could also be expenditure that you pay before you actually that you prepay before you actually incur the expenditure. So that's what you record under current assets. Okay, and then in terms of liabilities, so they're also classified into non-current and current, and then under non-current liabilities, we record obligations that are not due within a year. So this is where you'd record your long-term debt and also your deferred tax liabilities. So everything that goes under non-current liabilities is basically what you're not gonna pay, or what you do not expect to pay within a year. And then under current liabilities is the obligations that are going to be due within a year, which is what you owe in your debtors, which is your accrued expenditure, which you didn't pay throughout the previous period, but due to the agreement that you've got with the supplier, you need to pay within 30 or 60 days. So you put them under current liabilities, and also the current portion of a long-term debt. So what that looks like is you need to calculate how much you're going to pay within a year on your long-term debt, and then that portion you put it under current liabilities. The rest goes to non-current liabilities because you're going to pay the other portion over the year. So long-term debt could be your uh, your your loans, your long-term loans, which you would have taken whether for a car or a house. So that's what you record under non-current liabilities and current liabilities. But current liabilities, like I said, you only put the portion that you're going to pay within the next year. Okay, and then in terms of equity, so equity is basically the residual interest in the assets of the company after you deduct all the liabilities. So what this records is the retained earnings. If you've issued shares, you'd record the ordinary shares. If you've ever injected capital, it would reflect in the equity account. And then last but not least, we've got the cash flow statement. So the cash flow statement, it provides a summary of the company's cash flows, cash inflows, and also outflows over a specific period. So if we're going to, my example for this was that our financial year starts in March 2023, and it ends in February 2024. So our cash flow statement is then going to cover the inflows between March 2023 and February 2024. So it also covers a specific period only. And then under the statement of cash flow, you would have operating activities. Under the activities, you'd have cash generated or cash used by the company's core business operations. So basically here you record the revenue and the expenditure and what is offset, the offsetting of the revenue and the expenditures, what is recorded under operating activity. So it's basically what was going on in the income statement. And in the under investing activities rather, you would have the cash flows relating to the company's investments. So this could be if you bought an asset, if you invested in if you invested in other companies, if you loaned other entities, it could be that you purchased equipment within the period that I spoke about, or it's basically money that you would have put in so that you investing in the future, either in the future or you're expecting something in return in the near future. So that's what you'd put under investing activities. And then financing activities, it relates to the company's financing activities. It includes borrowing or repaying debt or also paying off dividends. So under financing activities, we only put there what we had incurred in terms of paying our debt, or if we had ever paid the shareholders of the company. That's what you put under financing activities. Okay, evaluating. So also financial statements, analyzing them would also help you to evaluate an organization's performance. So you also need to understand exactly which ratios you need to look out for, because just looking at the financial statements and understanding or knowing what revenue is and expenditure is not necessarily going to give you a good view of the entity. So what you need to look out for is you need to know your ratios. You need to know your profitability ratios. We'll go to the other ratios, but we're going to start with the profitability ratios. So the ratios would actually would indicate to you how exactly the entity is performing. So we are now happy that the revenue is increasing, but we need to know what is the gross profit margin of the entity. So what this formula does is that it shows us the profit after producing and selling the goods that we sold. So how you calculate that is you take your revenue and you divide that by the gross profit. So what's in the gross profit is basically the revenue, and then you less cost of sales. The cost of sales are the costs that you incur to get the goods that you sold to the position when they were. So for instance, I'm gonna make an example of if you're selling some lotion. So if you went to a store to buy lotion, you take that lotion and go home. You put in the cost to go to the store to buy the lotion, you put in the cost to come back home, and if and that is going to be your cost of sales at that point, and you put it under, that's what is going to be used to calculate the gross profit. So that when you understand that, you'll be able to tell the gross profit margin, the profitability of the product before you even go to the other expenditure that you incur day to day. So in here, you don't include your rental. You are not yet including the cost of your internet, your laptops, your vehicles. At this point, you're just trying to analyze at how profitable are the products on their own, including only their costs. And then you also need to look at the net profit margin. So what this indicates is, okay, let me start with the formula. So to calculate it, you have, what is this? The total income less the net profit, and then you also you need to remove, what is this? No, I think, no, my apologies. So it's the total income that you received, and then you have the net profit. So in that, you are able to understand exactly the ratio of the revenue against against the expenditure that you incur during the year. So with this, the difference between the net profit margin and the gross profit margin is that in the net profit margin, you include all other costs that you incur, and you now get an understanding as to, if we getting this much revenue, how much of it is covering our costs, and then you are able to get the ratios of that. Then the next ratio is the operating expenses ratio. So this assists you to obtain an understanding of the management of the cost. So you are able to understand how efficiently are you controlling the cost in the organization. So how to calculate that? You get the total expenses, you less the amortization, which is the depreciation, you less the interest expense, and then you divide that by the revenue for the year. And by that, you are now able to see that you could actually be earning revenue, but your expenditure is actually very high. So by virtue of that, you might need to actually relook at either budgeting for your costs, or you need to relook at either increasing your sales prices, for instance. So that could also assist you in that regard. And then interest cover. So this assists you if you've got any debt in the company, you're paying for interest. So it assists you to understand the ability of the entity to pay for the interest on the debt that you've taken. How to calculate that is, you get the net profit, and then you divide that by the loss before tax plus the interest expense, and then you also divide that by the interest expenditure. And then in terms of return on equity, it helps you to understand how effectively you're actually generating shareholders' profits using the assets and leverage. So what this assists you to get is, you are able to understand that, we've got this much assets, but how much are we generating from this, or how much return is it giving us on oh, sorry, my apologies. I had swapped this with the return on assets, but the return on equity assists you to generate to understand how much you are getting in return for the equity that you've put in the business. So what this assists you, how you calculate this would be net profit versus loss after tax, and then you have the prior total capital plus reserves, you divide that by 2, and then you also add the total capital and reserves in that. Okay, and then the efficiency ratios are also one of the ratios that are going to affect the income statement, and also sometimes they would also need to be mixed with the statement of financial position. So what if you've got inventory, you need to calculate the inventory turnover ratio. So what this helps you to understand is at what rate do you sell revenue. If you've got revenue that sits for too long, it might actually affect your cash flow, it might affect your cash flow in the organization. So if your rate is too, if you see that your rate is too high, it might be a time for you to look at buying only a sizable revenue, which in turn you then going to put the money that you should have bought, all the revenue that's just going to sit there, in other things that could help you in the organization. So just understanding this formula is going to assist you to make a better better financial decisions. And then accounts receivable turnover ratio, it evaluates how well a company collects receivables. A lower ratio basically means that you've got quicker collection tactics. So, and if your ratio is too high, you might need to relook at, if you've got contracts with customers, you might need to relook at drafting either updated contracts, or you might need to negotiate with your debtors and try to understand or try to make them understand the importance of the cash, the payment rather, of the debt on time, so that you have a good relationship, and also so that you don't only sell, but you also are able to collect cash on time. So just understanding how well your receivable turnover ratio is going to be is going to inform you to make better decisions, whether you are selling but not collecting, or whether you're selling and you're collecting quicker. And also asset turnover ratio, so it measures how assets efficiently generate sales, and also assist you to understand exactly how the organization is using the assets to generate the revenue, that the revenue in the entity, or rather the net profit in the organization. So the higher the ratios, they significant they signify they signify the better asset utilization. And then we've got liquidity and solvency ratio. So what these ratios help is, they help you to understand your ability to actually run in the next in the next period. So what we're going to start with is the current ratio. So the ratio, it measures your company's ability to meet the short-term obligations. So this ratio, it measures your total assets, and then it divides that by the total current liabilities. And in that, you are able to understand that if I need to pay this much debt, how much of the current assets do I actually have that are going to be able to cover this? If your if your ratio is less than one, it means that you are not you're not in good, you're going to have problems. So you might need to go back to your collection. You might need to go back to actually relook at, if it's your contract with your debtors, you might need to go back into that and relook, so that you are able to then meet your long-term liabilities, your rather short-term liabilities. And then a quick ratio, it assists you to measure a company's ability to meet the short-term obligation using the most liquid assets. So this one only includes the cash and cash equivalents, and also accounts receivable. Because sometimes what you might have under current liabilities might not be the most liquid asset. It may not be convertible into cash as fast as accounts receivable or cash and cash equivalents. So we just only include cash and cash equivalents in accounts receivable, and then we're able to understand that are we able to then pay for our current liabilities or not in the short term, in the short term that we're going into. And then there is debt to equity ratio. So this ratio measures a company's leverage and also the ability to meet long-term obligations. So we are now done with the short-term obligations. And then in terms of the debt to equity ratio, you calculate it by taking your total current liabilities, you plus that with your total long-term liabilities, and then you divide that by total capital plus the reserves in the entity. So what that would show you would be how much current liabilities do we have? Would they ever be able to pay for our total long-term liabilities? Because with the non-current assets that we've got, they're not easily what is this, convertible into cash. So with what we have, can we actually pay for the long-term debt that we've got? Because sometimes you could find out that some debt that companies get, they'll give you a condition to say, if you're going to perform at a certain rate, then we're going to need you to pay back the long-term liabilities. So if that is the case with you, you need to go back and calculate the debt to equity ratio and just understand, will you be able to pay for the debt immediately with your current current assets. And then with the times interest earned ratio, so this ratio measures a company's ability to pay interest on its outstanding debt. Again, my apologies for the debt to equity ratio. I had mixed it with something else. So total current liabilities would be total current liabilities plus the total long-term liabilities, and then you divide that with the total capital and reserves. So we're just basically showing how much do we have, how much are we owing, and then also how much in equity do we have at that point in time. And what that would show you would be how much are we investing, as the shareholders, and also how much are the long-term how much debt are we taking from other parties. My apologies for that. And then times interest earned ratio. So this ratio would basically measure a company's ability to pay interest on its outstanding debt. Okay, so one of the things that would help you to understand your financial statements would be being able to leverage the financial statements for business growth, and that what that would be for you would be, you'll be able to make decisions, you'll be able to then set goals for the entity, you'll be able to evaluate which resources to allocate, you'll be able to perform risk assessment, and then with you'd also be able to perform an evaluation of the entity, which would allow you to do benchmarking against the industry. So just to go back to decision making. So when it comes to decision making, once you've analyzed the financial statements, you are able to then understand the trends in the entity. So when you look back, you'd probably analyze that you're selling more of a certain product. So what that would mean that you then focus on the product in order to and set other goals in terms of revenue, whether you're going to increase revenue. And if you set it on that, it becomes something that you sell and you actually work on that. If you're making losses on a certain sale, then you might abolish that. So just understanding your financial statements would also help you to set other goals for the entity. And then resource allocation, like I said, resource allocation. If you understand that this product is not selling as much as the other, you then move all the resources to that particular product. And then with risk management, similar to that, so you'd understand that a certain product is just going to we're just going to buy the product, but it's not selling. So we end up losing stock. Therefore, what do? We actually need to abolish selling that good. And therefore, you are then able to make proper decisions for the organization. And then with performing of evaluation. So when when you're evaluating the performance of the organization, you are able to look at the industry if the information is readily available, because sometimes with smaller entities you might not necessarily have anything to compare with. But should you have a benchmark, or should you yourself set a benchmark for yourself to say, this is what I need to get, when you're now coming back and looking at your financial growth and your business growth, you are then able to say that, am I performing well, or am I underperforming? Or even, is the benchmark even correct for my business? Because what I'm actually getting and what I had set for myself, or what the industry is doing, what the industry benchmark is not correlating with my business. And then you're also able to identify trends. So if you see that, if you look at your financial statements, it might not necessarily be your financial statements, but it might be your month-to-month analysis of your financial records. You are able to then identify that in a certain month, what happens is that in January we are able to sell more than we do in, for instance, October. So that what that would mean will be that you then focus more in that month, and then when you come back in the next year, you're able to say that, okay, in that month we performed well. We had set the goal for October to be this much. Did we perform well? And then with measuring efficiency, when you evaluate the business financial statements, you are able to then tell that, is the organization able to sustain itself with the revenue that you are getting? Are we efficient enough? Are we profitable enough with the assets that we've put in the organization? Are we actually getting the better output of the organization? And then with investor relations, you are then able to attract investments easily. If your performance is well, if your business is growing at whatever rate it's growing at, you are able to actually get funding from investors, and you're able to build investor relations. And for those that already have investors, you are able to communicate good performance to the investors, and they'll actually be happy to see the organization performing well. And then with financial planning as well, so you are also able to to plan properly financially for the organization. You can either do a 1 year forecast, or you can do 5 year forecast, 2 year forecast, 3 year forecast, depending on your needs. And once you understand the business correctly, you are then able to forecast what are the what revenue are we actually going to get in the next 5 years, and then you budget on that. What expenditure are we going to incur? So what the understanding of your financial statements would assist you with budgeting is that when you're starting the business, usually you budget on assumptions. And once you now get to understand the business as the business goes, you are now able to understand that you might have under budgeted for a certain line item, or you might have over budgeted for a certain line item, and you actually adjust. And the good thing about budgeting is that you can also go back to the budget and you adjust should you see that the organization is changing. And also, once you have done your forecast, you're also then able to understand that if we are aiming to get revenue of this much, in the past we had incurred revenue of 1 million, but now we want to get revenue of 5 million. In that line, how much expenditure do we anticipate to get? Because if we're only earning 1 million and all our expenditure was 500,000, so what would we expect in terms of expenditure for revenue growth of 5 million? Then you are able to then do your budgeting properly, because now you understand exactly how the business is growing. If we're going to need 5 more employees, then you actually get to put together those notes. If under 1 million we needed 2 employees, under 5 million, what would actually that look like? So it also goes back to decision making, which would allow you to do some resource allocation. If we are forecasting for 5 million, what other resources would we need to actually get that 5 million? And then with problem solving, we are able to identify issues actually in the financial statements. So what that would look like would be, if you had budgeted to get a certain point, a certain expenditure for a certain line item, and you actually see that it's more than what you're anticipating. This could be probably your rental, or your water and electricity, or it could be your fuel. You're expecting that you don't pay that much, but in the year that we were in, there was no fuel increase. Just an example, there was no other. We're not traveling outside the province, so there were no tolls or anything. But the expenditure had actually grown. So when you now get to actually dive deep into the financial line items, you are then able to see that there could be issues with fuel and expenditure. And what that could help you with would be to actually even put together a policy that would counter those problems. So it could be travel policy, maybe you didn't even have in the first place, and you can put that together. That would actually stop uh, whoever is driving the vehicle from just spending however they spend. Or also it could assist you to just, if you're giving your employee a card, you could limit the amount that you put in there, so that you limit how much they actually spend, because some of the expenditure could actually be personal expenditure. So not just taking your financial statements and putting them in your drawer is not advisable. So you just need to look at your financial statements, analyze them line by line, and then once you identify issues, you are then able to put together you are able to decide, you are able to do planning for whatever issues that you identify so that you don't incur them again. And then you're also able to develop the solutions. So I think I'd already spoken about developing solutions against whatever issues that you identify in the financial statements. You're able to do financial planning, you're able to do evaluation, and you're also able to do decision making. So what this slide gave me was more of a summary of what it would help you with. So I think this would be more explanatory to this, but I'm just going to skip this because it's explaining what I had spoken about already. Okay, so just to do a poll, which topic would you like us to cover in the next webinar? Is it labor laws, payroll, employee benefits, and taxation, tools and techniques for creating effective process documentation, and if other, can you please specify which ones you'd like us to touch on? Okay, I'm going to give you a minute just to respond to the poll.
Okay, Candice, I can see you have a question. Can you please type it on the chat? Or you can open your mic.
Okay, I think everyone has put in their suggestion in the poll. Kudzai, thank you. I'm handing it over to you.
Candice, do you still have your question? You can just put it in the chat, but whilst we are still on that, we just want to thank our speaker, Mr. Baongongo. As we have seen, the importance of having your financial statements as a business is very critical. It's not just about compliancy, but it's about understanding your numbers and how you see how it's going to benefit your business in terms of decision making, in terms of financial planning, in terms of problem solving, as well as you'll be able to identify the root causes of the health of why your business is not financially healthy, and you are able to, you'll be able to invest. So thank you so much, Ms. Bongo. And then whilst we are still on that, if you just check in our chat, we do have exciting news for you at Brandmore. We have partnered with Anchor, which is a premium wealth and asset management company. So if you can see, just take note of the date. We have a breakfast meeting on the 18th of October. So can you just take note of it, and also included it in our chat. I just see here, I haven't seen the question for Candice. But if there are any other questions, people can just share so that we can engage and we can assist you in the best way that we can, as we are Brandmore and we are your accountability partners, and we are here to serve your needs. Okay, Candace.
Okay. Hi. Thank you so much for this webinar. Yeah, I was just raising my hand to say that I did want to put something on the chat, but it says chat disabled on my side. So I don't know if other people are able to. So I was just asking if maybe it can be enabled. Thank you.
Okay. So Candice, you can still ask while they're enabling the chat. In the interest of time, you can just ask.
Or you can also as well just directly send us Brand More. We do have our contacts here with us. Yeah, on the Brand More chat. We also have our contact numbers with you. Then we'll be able to assist you. Okay, in the absence of questions, we are still here. We are accountability partners. You can get us at 7 Pioneer Avenue, Midrand Park, and our number is also here on the webinar. As you can take note, 011-026-3052, or you can get us ourselves on our cell phone number, which is 083-246-5905. And we are Brand More, and we are accountability partners. We are here for you. Thank you.
No one asking questions.